All right, here we go. Just waiting for this eye.
Yeah.
Patiently. All right, here we go. We are live and ready to go for another week of Self-Wealth Technical Analysis Edition. Jason, how are you today?
Hey, Rog, I am well. All good. Looking at some charts. Interesting things to talk about today, I think. So, and also some viewer questions. I'm looking forward to a few of those. We always get a few good ones to look at, and some some stocks and some ideas, and yeah, all pretty good.
Yeah, we're looking forward to a few viewer questions and obviously stocks that you want to analyze. So, as usual, we'll go through the markets at the start, the Aussie market, the US market, and the Hong Kong market in general. Then we'll go through any viewer questions, and then if there's any stocks that you'd like to analyze, please get them in, relatively quickly, so we don't go too far over time and take up too much of your time as well. Right. So, just want to get this out of the way, Jason, before it pops up. I just want to say well done to the Blues. Looks like they won at the State of Origin, right?
Oh, you got to get a win. One year we had a pretty lean period there for some time, but yeah, it was good coming back from one down. Who would have thought? Great result.
Yeah, good result.
Just got to stop the Swannies going down by a couple of points in this habit they seem to be getting into over the last three games.
Yeah,
and then all is good. Blues, Swans. Well, at least I'm happy. Probably not everyone, but some of us.
The AFL season's it's a good one this year. There's a lot of that's for sure. There's a lot of anything can happen, right? But anyway, when I hear just to talk about the AFL, but I should mention that Queensland won the female State of Origin. Is that right?
That's right. That. Yeah.
So it's even for Queensland, New South Wales. I'm sure everyone's happy up that side of Australia, up that side of East Coast. We're here to talk about self-wealth, about technical analysis around the markets, though, obviously. So welcome to everyone here on today and listening to us, or maybe even on replay if you do watch some of these. I do have a few clients that watch this on replay as well, right? So it's good to hear. Now, before we get going, Jason, can we just have a look at the disclaimers?
Yes. So as always, everything today is general commentary only, and this outlines all of that. And the other important point is that I'm not part of Self-Wealth. My business is Motion Trader, so you get all my details up the top. In the top section, licensing and all of that, and below there we've got the self-wealth information and licensing. Again, general advice, no personal advice given in this series that we do.
Fantastic. All right, and you can see all those wonderful disclaimers in the description of the video as well. All right. So now, first of all, I'm going to talk about what happened quickly on Friday, and I think that will be our first tip. We'll have to have a look on our first tick, I should say, that we'll have to have a look at later on. Jason, how were you? How was you? Were you affected by Friday's outage or what?
Not very much at all. Only slightly. I was just I do the strategy sessions on Friday, and part of that involves uploading some content to YouTube. But just a little glitchy bit. I didn't know why I was getting it, and I found out later on it was because of this stuff. Otherwise, yeah, no, I sailed through it, fortunately.
Yeah. Now, did you know that CrowdStrike, which is the company that's obviously behind all this, was a listed company in the US beforehand?
No, I haven't followed that. I hadn't heard the name CloudStrike before. I know there's a CloudFront and a Cloudflare, and now apparently there's a CloudStrike. So there's a few similar names out there.
Yeah, CrowdStrike. So I think it's CrowdStrike anyway. But no, I don't think anyone knew this company beforehand. But I tell you what, I think everyone knows about it now, and it'd be interesting to see what the charts look like around that company, because I've noticed that it is a listed company on the Nasdaq, right, or on the US exchanges anyway. But before we get into the specific tickers, let's have a look at the ASX market to start off then.
Right. Okay. So let's jump over to the ASX 200. And last week it was all about this breakout. That's what we were talking about, the breakout from the range. And this week we've got the pullback. So I thought it'd be interesting today to just talk through, should we be worried about this pullback? And we can look at that, and we'll come back to this in a moment. But just sort of looking at how we got here, how we get to this point in the first place, and really all comes back to the April highs, where this range all started to form, and this has been the dominant feature over the last 4 months. This big trading range, and the other feature that's been evident has been the support that has underpinned the market when we've had the pullbacks, and that's largely happened around these moving averages, the 50 and the 100-day moving averages. And that's been the case going back to January. Each time the market has pulled back, there's been buying interest around the moving averages. And when you get that sort of price action, it does support an upward trend. And I guess that's one of those key things you want to look at in market structure, that the dips are being supported, and that's been the case this year. And the other feature here is that the range has been a contracting range. You can see how the price action has compressed, and then it's broken higher. And it's an interesting thing with trading ranges, because this is how they often work. We get these periods where everything's quite dull, not much is going on in either direction, and then you get a burst of activity when the market breaks. And this is how a trading range works. It goes from that period of quiet trading to a period of activity. It transitions on the breakout. And the breakout has probably been, that's probably been a combination of fresh buying as the market has moved outside the range, and also short covering, because there's always, in a market, there's always people who are looking to short the market at around previous highs. When the market breaks to a new high, those shorts often cover. That's where a stop losses would typically be for people trying to short. And so we've got this combination of fresh buying, short covering, taking the market up. Now the market has pulled back. We've got this fairly steep sell-off from the Thursday's high. So coming back to that earlier question, does this change anything in this overall bullish positioning we've had to this market over the last few months? And at this point, I think the answer is no. I don't think it changes anything. In fact, I think it's probably a positive to have the market pull back after a breakout. The sort of thing that does concern me is that when you get a breakout and the market just moves higher in a really steep move higher over a relatively short space of time, that sort of price action often can be a concern, because that's often when you get, it's often a sign, when a market really runs hard and it gets stretched above these moving averages, it's often a sign that you've got the FOMO buying in there. And when that comes in, the market does become vulnerable to a larger shakeout. But in general, when we get these moderate, or even in this case, I'd say this is a modest pullback, I think it's normal. It's normal. It's constructive. It lets the market just consolidate that initial break, and then often we see the market then move on up to higher levels. So maybe like it doesn't always work out like that, but that's often what happens. So one of the possibilities that we could see over the next several weeks is maybe that one possibility is the market just tracks sideways for several weeks, forms a new platform above the breakout point. And then from there, we potentially see it move higher. So it may look completely different to this. But this is the sort of pattern where I often look for in the individual stocks, because what it does, it lets those moving averages catch up. And just like estimating something for moving averages, the price, I often like looking for price action that breaks higher, then compresses sideways back to the averages, and then rallies again. Doesn't always work like that, but quite a bit of the time it does. So that'd be one scenario to keep an eye on. And other ways, of course, it could go. But look, for me, that would be probably my favoured case, that maybe we see something like that. As I say, all sorts of ways this could play out. We'll only know the actual path in hindsight. But I think just understanding some of the possibilities is helpful, because as we see the price action evolve, we start to see the type of price action which maybe I've described there, and you get a feel for where the market may be able to go next. Of course, no certainties with any of this. If prices start slipping back inside the range, well, then we need to be ready to manage risk. We can never discount a false break. That's a charting structure which we sometimes see. Not all breaks play out into big trends or ongoing trends. So a move back within the range, that would be an area where we manage risk. We've got stop losses, trailing stops, that sort of thing. That's not where we are at the moment, but it's being aware of the possibilities and then being able to respond to them if and when they unfold. But for now, I think the base case is I think we go with the break. Prices above the moving averages. I think the path of least resistance is to the upside. I'm long the market. That's been the case for months now. But I'm also actively looking to buy stocks that are rallying off their moving averages and breaking higher. I think that's the way we currently approach this market. Benefit of the doubt goes to, for me, it goes to the upside.
Yeah, so it's interesting to hear the different language you're saying, like now compared to that when we were in that trading range, you know, a month ago or a few weeks ago, where you were saying, a little bit more cautious. You know, I'm not so long, but just making sure I be honest to my stop losses and things like that. Whereas now we've become long again because of that positive price action. And it's hard to know what's going to happen in the world that actually make it go backwards. But we're not that type of traders, right? We don't really care too much what the news is. We just read off the charts, and it's all priced in generally, right? So, but the rhetoric has changed a lot with the way you speak, Jason. So,
it's been a case of during the consolidation. It's been a case of cautiously optimistic, in that the dominant previous move had been upwards, and so it's been a case of being bullish towards the market since back in early December when price got above the moving averages and started rallying. So that's something we've spoken about for months. We want to be the base case is long the market. And then when the market starts consolidating, well, it was a case, we've had a big run. It's normal that the market consolidates, but we don't have a breakout until we have a breakout. So it's cautiously optimistic that the default position remains upwards, and now we have that breakout. So, and this is why I always talk about wide trailing stops. The aim for the wide trailing stop is that you can see off these periods of consolidation when they periodically occur. So I've got lots of good positions which were established last year as prices were starting to rally. I don't want to lose a grip on those good positions when the market goes sideways for several months. So the wide trailing stop, it can really help see off those consolidations. But if things break to the downside, you've still got that risk management in place. So you can then close out positions which had gone really well, but then start to roll over and get to a point where they do need to exit the portfolio. You want just trying to avoid those situations where you ride a stock all the way up and then you ride the stock all the way down. Lots of people do that. It's an avoidable situation if you've got a trailing stop. So yeah, it's as I say, path of least resistance. It does seem to be, at this point, it seems to be the upside.
Yeah, we'll visit one of those stocks that potentially could have that effect very soon. But yeah, it looks like a natural break and retest at the moment, which is great to see on the ASX. What about the what do you call it? The S&P 500.
The S&P 500.
How could I not know that? All right.
So let's go over to the S&P, and I think this has been another significant week for the US markets. S&P hit another all-time high last Tuesday, so not yesterday, but a week ago. By my count, that takes to 41 all-time highs for the year. So where's the year start? The year starts back down here. So yeah, in this period, 41 all-time highs. So that sounds like a lot, but it's still well below the record from 1995, where we had 75 all-time highs in the year. So you never know with these things. Big numbers can get bigger. I think that what we're seeing now, we're getting the pullback over the last few days. I'll come back, talk a bit more about that in a moment. But I think what the most significant price action in the US markets has been, I don't think it's been so much in the S&P 500. I think it's been elsewhere. So one of those segments has been in the Dow. So this has been interesting because it's clearly broken out of this big sideways pattern, which had been in place since March. Not dissimilar to what we've had in the ASX 200, a little bit different, but it's still nonetheless that lengthy range-bound period. And so we got that break to the top side. So the Dow spent nearly 4 months within this range. Again, finding support along the moving averages. So it gave that, that underlying bias was that this was going to be a consolidation which would resolve to the upside. And of course, now we've got the breakout. So I think that's worth paying attention to. And it's also rallying off the moving averages. You could see really was getting nice support along those averages, particularly in the last couple of months, and it's just accelerated away from that in the last couple of weeks. Another notable breakout has been in the equal weight, in the S&P 500 equal weight ETF. So this is an ETF. The ETF is RSP. And so the market capitalization, S&P 500, it's like the largest stock has the most influence, the smallest stock has the least in an equal weight. All stocks are ranked equally. And this is, this is what I think what's really important about this is that it indicates there's a broadening in participation in the rally. Because what we've had over the last, particularly the last probably 4 months, it's really been, the S&P 500 has really been driven by a few big tech names like NVIDIA in particular, Microsoft, Alphabet, which is the company for Google. It's really been a really narrow rally. The equal weight's been tracking sideways, looks similar to the ASX 200, looks similar to the Dow, finding support along the moving averages. But then in the last couple of weeks, we've got this breakout, another breakout. So there's a few breakouts going on at the moment. So there's more stocks now participating in the rally. I think that's important because healthy rallies are rallies which do have that wider participation. It's not just a handful of stocks. It's also interesting to see, if we just duck back to the S&P 500 for a moment, it's interesting to see that the S&P 500 has been lagging the equal weight over the last few weeks. So just looking at where the S&P 500 is trading now, and you come back across, it's around the 8th of July. It's trading around the same level it was about 3.5 weeks ago. So just take a note of that, 8th of July. Now let's go back to the equal weight. Let's find 8th of July. And here it is here. So look what the equal weight's done in that same period. It's trading well above where it was at that point. So you can see it's not the big mega cap tech stocks which are driving this rally. It's it's the rank and file. It's the middle. It's the lower end of the S&P 500. That's where we're seeing the strength. And it all comes down, I think, to some of those overstretched tech stocks pulling back. So we can just quickly let's just quickly have a look at one of them. Let's just put NVIDIA up on the screen, and you can see there's the pullback. Similar stuff going on Microsoft and Alphabet. So that's why we're seeing the S&P 500, the index, underperformed the equal weight over the last few weeks after this big period of outperformance, which has had. I've been talking about this, saying we've spoken about over the last few weeks. We've been talking about focusing on the components of the S&P 500 rather than the index itself, and we're seeing that come through now. We're seeing the benefit of that strategy come through now. When you look at the equal weight, it's the components which are doing better than the actual index. So I think that remains, for me, that's the focus. It's remaining on the individual stocks, looking for the right setups within the index instead of just looking at the index itself. I think that still remains the play at this time.
Yeah. All right. Fantastic. Well, let's have a look at the the Hong Kong market, and then the Chinese one.
Yeah, Hang Seng. look, it's still not gaining any traction, Roger. We've got this 2-month decline. It looked like we might have been getting a bullish structure develop up until May. Things were looking really encouraging. But this decline, it just keeps going on. There's no traction on the rallies. It's still holding above this support at around 1700, but it's only just above it now. Look, until we get some sustained momentum, I think there are just other opportunities worth considering. Not every emerging trend kicks on and becomes a big trend. Lots of emerging trends fizzle out, and what you do when that happens, you go, okay, this one's not ready to really go now, so let's shift focus to something else, and you just keep moving around until it's like musical chairs. You keep moving around until you've got the right spot. This isn't, the money flow is not coming in here at this time. Looking at the Chinese market, it's the same story. We've got this lackluster rally off the lows from July, but there's just not enough here to re-engage my interest that I had when things were looking interesting back in April, May. It's I think it's now off the boil at this stage. Focus our attention elsewhere.
Yeah, all right. I mean, I'm just asking randomly, Jace, but why do you think that is from a fundamental point of view? Would you know, or?
I don't know. I don't follow it. It's like you can conjure up something to fit whatever scenario you want to talk about. So I won't just like grasp at things, because I'm not following the fundamentals. It's the price action which really interests me, and sometimes you can see a bullish scenario building, and often you can see those scenarios then continue to push forward, but not all the time. Sometimes they just fall back on themselves. So rather than persisting with something which isn't happening, it's like, well, okay, you just accept, okay, this one's just not for now. It was looking interesting, but it's not delivering at this time. So rather than continue to try and push it, it's just pull back and look elsewhere. And the fundamentals all become clear in hindsight. It's like, this is why fundamentals can be so hard to trade off, because it's all clear when we look back. You go, oh, okay, that's why that happened. Like, the COVID decline and rally is a case in point. It's like we had the collapse, and then for the next 6 months, so many people were looking for the second leg of the collapse, which never came. But we look back at the fundamentals now and we say, oh, of course, all this money was pumped into the economy, into the financial system, everything reflated. But that's in hindsight. It's like at the time, people were focused on unemployment has soared. They're looking at fundamentals, but the ones which weren't driving the situation. Of course, some people called it right. Some people did really well. Other people were looking for crashes which never came. So I think the price action is our best guide. Not for me anyway. I prefer to look at the price action rather than try and decipher the fundamentals. It's not where my edge or my skill set really lies.
Of course, I know that. I just thought maybe you know something that we all don't know, right? So, but that's okay. We'll push on with some of the more technical questions here. All right, let's have a look at the first. Actually, we'll get onto some of the tickers shortly, but there's no example here. But how do you recommend re-entering a trending trade after hitting a stop loss without breaching the ATO's wash rule? I don't know what that is, but maybe you can shed some light. And there's no example, but let me give you an example of a trade that could potentially have hit its stop loss now. We were talking about it for quite a while last week. Let's have a look at DRO, Jason. Maybe you can use that as an example if it has hit. Has it hit your stop loss?
Well, Drone Shield hasn't hit my stop loss. It's I'm not. Look, I don't know what the ASX wash rules are. It doesn't. The way I trade, it's. I don't know. You got to go away and research what that's all about. I'm not even going to guess at it because I just don't know.
Well, let's have a look at the first part of the question. More about how do we re-enter after hitting a stop loss. So,
Let's come back to Drone Shield because that probably goes in a different direction, that conversation. What's a stock I can think of? There's something. It's just not quite coming to mind. I'll get another chart of. Let's try. This is a stock which hit a stop loss, but it's like, okay, this is a stock which this was a motion trader stock. I had it in my own portfolio. It's why it kind of comes to mind. Duratec, it hit a stop loss. Its stop loss was in around this point here. Back in March, hit the stop, continued lower for another couple of months. Looks like it's starting to build back up. So this could come back onto my radar. It's back above the moving averages, so it's below the moving averages. So I don't want to know about it. But now it's stabilized, started to turn back up above the moving averages. Moving averages are close to crossing. So from the way I approach stocks, I want to see the 50-day average get above the 100, which isn't too far away. So for me, a re-entry point, if this continues to rally, it could be around $1.34. So the idea with the trailing stop is we don't know how long a stock is going to decline for. Some continue declining for months, and you just got to get out of them because they're going to destroy a lot of capital if you just hang in. So you cut the position, but doesn't mean that you can't go back and look at it later on. For me, a stock like this, let it fall. It hasn't continued to fall. It looks like there's some buying coming back into it. So once it's back above those moving averages, the average gets up to a new high point. Like I'm looking at a 70-day high. That's how I could get back into a stock. Duratec. The same sort of, like, I guess if we look at this period here where it had a sharper decline, if someone had been stopped out near a low, like let's say we had this was our stop loss. My wide trailing stop was able to see this correction off, but just say you had a closer stop, got stopped out, stock starts rallying again, it's back above the moving averages. Once it's above the moving averages, I guess it's within this region here where I'd consider buying it again, where it's gotten back above the averages. It looks like it's regaining some momentum. That's where I could get back in. So I'm not going to try and get stopped out and then buy it as it's below the averages. It's really waiting for it to get back above, show some momentum. That's where I might get back into a stock like any stock which falls, triggers the stop, and then starts rallying again, buying it back into strength, not worrying that I've given up a little bit of profit potential in that piece where I've missed out, where I've gotten out, and where I might get back in. Don't worry about that. Focus on going forward. And if the price structure is suitable, don't think twice about getting back in.
Okay. All right. Fantastic. All right. Let's have a look at some stocks then. Let's have a look at IMB, please, Jason.
IMB. So this has been in a nice uptrend. I'm not sure whether this is a motion trader stock or not. I suspect it's not. Maybe it turned up recently. I think it might have turned up in the signals recently. Hasn't been in there for long because when it was down at these lower levels, it was a low price stock. They're usually too volatile, and the volatility filter takes them out. But at this point, this is a stock which is an upward trend. If I was in this stock, I'd be holding it. It's trading up above these rising moving averages. I'm not sure it's an asymmetric entry point just at current levels. So I'm not necessarily looking to buy it just now, because I'm looking, if I buy it now, where do I put my stop loss? Just to get back below the 50-day moving average, it's a bit of a decline. So I'd probably wait for the next consolidation to consider buying it. But if I had it, I'd be holding it. Wide trailing stop. These are the sort of stocks which can go a long way. We never know which ones until later on, but it certainly has the potential. It's got the characteristics of a stock which could go a long way. So I definitely want to be holding it. I definitely want to be giving it room to move, because you've got to be able to see off these larger consolidations. If you have a close stop loss, you're probably going to get knocked out of a stock like this. So this is why you've got to give it those wide stops, and like giving it like something like that, giving it like lots of room to pull back to the averages, having a stop way lower. It's we often talk about this. It feels daunting, but that's how you can get stay on some of these big moves.
All right, fantastic. Let's have a look at LOV.
Yeah, so this is uptrend remains in place. Broke above. You can see this overhead resistance got above not long ago, just consolidating above it at the moment. So again, this very much does remain a hold for anyone in it. The initial signal for buying this was back down around early January, and it's interesting to just look at the structure, how we've gone from below the averages to above, and then we had that sideways to downward pullback back to the averages where for the consolidation. This is what we were talking about with the ASX 200 earlier. I was talking about maybe a sideways compression into the averages, but sometimes we get this sideways to lower compression as well, where it comes back to the averages and then rally. That's quite normal when you get a market that breaks higher, runs above the averages, comes back and then rallies again. And that's what we've seen unfold over the last few months, last 5 months, I think. We're really seeing this traveling sideways. It seems to be now breaking out of that sideways consolidation. So for anyone who likes a stock, it's a reasonable buying point at current levels. And you go, where's my stop loss? Well, it could be just back below this resistance, which is now support, back below the 50-day moving average. I'd probably want to give it a bit of room. I'd probably want to give it at least 7%, or it could even be below what would that be, the July low? That could be like 12%. So yeah, 7 to 12% of stop loss for anyone wanting to buy it at current levels, and see whether this trend can continue. As we spoke about earlier, not every breakout follows through into an ongoing large trend, but then plenty of others do, and that's how you play them. It's asymmetric in that risk can be contained fairly tightly, and upside is opened, and that's what we want: open upside, relatively small risk. So this remains a stock to hold, possibly a stock to buy if you're interested.
All right. What about OFX?
A lot of similarities with what we just spoke about, in that uptrends in place. So it's a hold. Anyone with this stock, I'd be holding it because we have a stock which is trending above the moving averages. So we've got the uptrend in place. Now it's had a good run above those averages, and now we're getting the sideways period, like we did with La Vista. So look, this could continue to give a La Vista type structure. This could continue to trade sideways within this rectangle for several more, maybe several months. Continue to let the moving averages catch up, and then from there, maybe you get a breakout. So it's certainly a hold. Is it a buy? I'm probably not a buyer at the moment because it's sitting just below the recent high. It's above the moving averages. I'd be wondering whether it does continue to consolidate and we get a breakout later on. Of course, other things can happen. It could top and start coming down, but that's not what the price action is currently doing. So at the moment, I think benefit of the doubt with this goes to the path of least resistance being up, and that we get consolidation following a strong upward phase. So as I say, I'd be hanging on, and I'd be watching how the consolidation plays out to consider another entry possibility.
All right, fantastic. What about PDN?
The uranium stocks. Well, this is an interesting and developing situation in uranium. I'm not a buyer of uranium stocks at this point, not with the price pulling back and not with the uranium price sitting below its moving averages. It's in a vulnerable position. Now, vulnerable doesn't mean it's going to fall, it means it's vulnerable, and it could fall and could fall quickly. So I'm careful about buying the dip. I want to buy dips that are coming back to moving averages. That's if I'm going to buy dips. I want to buy dips back to the averages. That's, I think, the time to buy them. At the moment, we've had a rally back to moving averages, which are declining, and then the stock has come away from it. I've been lightening my uranium holdings in the last 3 or 4 weeks. I've got one which I'm currently managing an exit out from. I'm still long the sector. I'm still positive towards the sector over the next maybe year or two, but I'm just cautious with where the current structure is. The risk with this is that we continue to see downside movement. So I'm looking to protect some capital which is in the sector, and I'm not looking to buy this dip. Like, it could, of course, bottom here and turn up and go into a great trend. So not to say it can't happen, but I think you play against the odds when you're buying dips which are declining from moving averages which are rolling over. I think you play that strategy out. I think over time you tend to get some poor outcomes. So they're not the sort of dip I want to buy. Just jumping over to the uranium price. This is like, I talk about this in my weekly strategy sessions on Friday, and what we have, you can see this consolidation below declining moving averages. So that's a concern. When you get that, the risk is that the rallies are being sold and we end up with price action that starts to come away. So that's not a prediction for what's going to happen in uranium, because I don't know, but that's a concern that could happen. Likewise, we could also see that we're breaking below some support at the moment, but if there's no follow through selling, prices could quickly be back up within the range. So it's really on a fine line at the moment. I don't know which way this is going to go, but I don't want to be adding to risk in this situation. I want to see how this plays out, and then if it plays out to the positive side, I can look at putting more money back into the sector. But at the moment, I'm inclined to take some money out of the sector and see how this plays out.
All right, fantastic. Well, let's have a look at a question around the BMN chart. So we'll bring up the BMN chart. David here. Jason, could you please show the BMN chart with the interactive 14 and 10 ATR? What is the correct method for determining and measuring the correct exit point?
Well, there's no single best exit point. It's going to vary depending on what your goals are, what you're doing, what strategy you're using. I'm using wide trailing stops because I'm aiming to trade medium-term trends that might run for 1 to 3 years. So that what I do is going to be different to someone who's trading a stock which they're looking to run over the next 3 or 4 weeks. So it depends what you're doing. That's the first point. So we can put a trailing stop on this.
He bought on in December 2023, just as an FYI.
Yeah, so I've bought the same stock around the same time. I'm using the motion trader approach for my stops. So this is pretty similar. This is just a trading view default trailing stop. It's and you can vary it to whatever width you like. So their default is 3. So you can see the 3 ATR stop on here from a December. Well, that's an August entry. So we're talking. What was it? December entry. 2023. Yeah. Okay, so you can see, putting on for a December entry, a 3 ATR stop. It doesn't get you that far. You get a profit, which is all good, and that could all tie in with the short-term strategy. But it's not what I'm doing. So I'm using a longer strategy. Let me put a 10 on. So using a 10 ATR strategy, it's pretty close now. It's just sitting above it. It's only a few cents above it. So 10's not a magic number. We could use a 9 ATR stop, which would have already triggered. We could use an 11 ATR stop, which gives a little bit more room to move. And you look at different stocks over different times. And if you could pick and choose based on hindsight, you'd go, oh, this time I'll use a 9, this time I'll use 11, this time I'll use a 10. But we can't do that. So find the number which works for you, find the multiple that works for you. And I think try and use it consistently. Because they're all going to give a similar overall outcome, whether you're using 9 to 11 or some reasonably close variation. I think the right thing to do for someone looking for medium-term trends has been to give this plenty of room to move, because that's how you get on those big trends. But not every trend is going to turn into a mega trend. This has been a good trend, which looks like it's come to an end. That's going to happen. The price of using the wide trailing stop is you give back quite a bit of profit at the end, but it's also how you get on stocks which could go 300, 400, 500%. Most stocks aren't going to do that, but you only need that to happen a few times every year or two, and that they can really skew your performance to the upside. I think the right thing to do is, if you're using a 10 ATR stop, is to go, look, okay, I've got to call quits. I've got this stock. I'm within a whisker of calling quits on it right now. It's what the worst thing to happen for me is to just keep holding, and it just continues to move down, and I keep holding and I keep holding, and then I say, oh, it's too late to sell. I'll keep holding. So many people do that, and we want to try and avoid that. That's why we use a trailing stop loss to try and give us that line in the sand. So you don't want to play around too much with it when you cross that line in the sand. Just accepting not every trade is going to be a super trend.
Yeah. All right. So it's just above that trailing stop now. How would you? Are you waiting for the price to close below that line now, or are you?
Well, the motion trader stop loss was a touch higher 2 or 3 weeks ago. I've been trying to manage my way out of the position because I thought we were going to get a bounce back to the moving averages, which hasn't happened. So I'm about to have to bite the bullet and cut this position because the bounce I thought was going to come hasn't come. I'm looking at the uranium price. It looks like if it's going to bounce, it looks like it'll bounce any day or fall any day. So what I'm doing, it's like this isn't part of my. It was a motion trader stock, but it wasn't in my motion trader stock portfolio. This is sort of a tactical trade I was doing on the side, but using the same motion trader principles, not exactly the exact levels. Everyone's got to call it differently. Some people will say, look, this is a long-term hold. I'm doing something different. So there's no magic line in the sand which says, okay, this is the point which means this stock is now going to halve or be in a downtrend for the next 3 years. I don't know what that point is. And if there is a point, maybe it bottoms in this time next week and it starts rallying from a slightly lower level after just triggering the stop. That's entirely possible. Like we operate in an environment of uncertainty, and we're always trying to manage that uncertainty, and we just don't know. And that's why we're using overall outcomes over time to judge our strategy, not expecting to get the perfect outcome from each trade.
Yeah. All right. Fantastic. Let's have a look at BOQ, please. BOQ.
Yeah, this looks like a this is a nice setup. Financial stocks have been doing well lately. So we can just look at a few aspects of this. I got this drawn on from an earlier time when we looked at this downward trend channel prices broke out from in December, and it's really been tracking sideways since that time. And often you do get this. You get these breakouts, and this is the thing with breakouts. A breakout doesn't mean a market's going to just go tearing away in the next few weeks. Often you get those pullbacks and those consolidations, and we got the initial break, had an initial run, then pulled back to the moving averages, and you don't know how long a consolidation is going to go for. So this one has really continued on for the last 7 months. We can just draw something in here just to demonstrate that range. It's really been a range-bound market, but I think with a positive bias towards it, because it does look like, is this a basing type of period that we've come out of, breaking out of that downward trend channel, sideways for a while, establishing a new base at a higher level. We're currently above the moving averages, which are positive, and we're towards the upper end of this range. So my bias with this would be this will break out of the range and trade higher. So I'd be happy if this was a stock in my portfolio. I'd be comfortable holding it. Just see whether this range resolves to the upside. That's my feeling that it will. Of course, it mightn't. So we have stop losses and we can exit the trade if it starts to break to the lower end of the range. But at this point, I'd be favouring an upward resolution from this. If I didn't have a position in this and I was looking to get one, I'd probably give it a little bit more. I'd probably like to see it above the April high, buying in a little bit more momentum. But yeah, overall, I think this is an encouraging setup.
Okay, fantastic. Do you think BHP has bottomed?
Well, this is an interesting one. I mean, looking at this myself, and you can see this support which I've drawn in. Look, at the moment, it's showing us breaking down. I don't want to buy this dip. We talked about this a little bit earlier. I want to buy dips that are coming back to the rising moving averages, not situations where we've got a market which is rallying back. Like this also comes back to how the uranium price currently looks, in that we've got a market which is consolidating below declining moving averages, so it opens up a degree of vulnerability, and it's also been in a range. So how can we draw this in? You can draw in the lower end of the range, but you can't really draw it at the top. We've got this point from April, and then we've got a higher point from May. You don't draw a range with a rising line. So just like roughly marking out the top of the range. Oh, you can look, or even just say, look, that's your range, and you just take off this that one. Maybe we just say that. So BHP has been in this range. Now it looks like it's breaking to the downside. So I don't want to buy this dip because there's that vulnerability that is this going to continue to ebb away? I've been looking at this favorably in that, is this consolidating along this support line, getting ready to start to push back higher? And it's also within a bigger range still. So we've got this smaller range within this larger range, and with it at the bottom of the range, was this going to be a support that was going to hold and start to see this price rise and then ultimately break to the top? At the moment, we've got this price action which is breaking to the downside. So for me, it's a case of just step back and watch it, see what happens. If there's no follow-through selling and prices quickly make their way back up, well, maybe we can get a false break, false breaks are great, because false breaks, where a market breaks a level which should have led to follow-through selling, when you don't get that follow-through selling and it quickly rebounds, it's a sign that anyone who wanted to sell has already sold, and this is a market which is being accumulated. But we've got to just step back and just watch this price action, see how it evolves. I don't want to buy it at the moment. If we're back up to the moving averages and getting above there, well, let's look at it again. But for now, just being careful with it. Same when you look at Rio and Fortescue, the other big iron ore miners, they're just not looking like they're stocks to buy at this point.
Mm-hmm. All right, let's have a look at IFL.
So this has been an out of favour stock for a while. Like, is this the one, or is it another false start? We've seen this sort of price action before, But every time a stock starts to rally, well, this could be the one. So it's worth paying attention to. Moving averages are close to crossing. Like, could this be a basing period that has had? It's certainly possible. It's a stock with potential. I'm not sure. I'm not sure I'd be a buyer at the moment, because I think the risk is just a little bit much to manage. Oh no, it's not so bad. So it's like, say, 15% below the moving averages, and the upside potential. Yeah, look, it's a stock that could feasibly double. So I don't know anything about the financials. I don't know anything about the company. Someone liked this company for a particular reason. Buying now is buying into the momentum. But of course, if you buy now, you're also accepting that maybe it is getting a bit above these moving averages. So often we see stocks go from below the averages to above, and then they then we get the sideways chop back to the averages, and then we get the rally. We look at this pattern all the time. The moving averages catch up to the compression. So that's the sort of thing I'd be looking. So for me, I'd like to see the following price action set up the next potential entry opportunity. That said, for someone wanting to buy it now, because maybe it just steams off. Chances are it doesn't. Chances are it does consolidate, because the moving averages do ultimately catch up and the market does come back to the averages. But it could be bought here. Nice trailing, 15% stop loss perhaps, but being aware that maybe you do get that consolidation over several months to correct this initial sharp rally.
Okay, fantastic. All right, well, let's just have a look. Do you mind going back to Drone Shield, since that's the one we were talking a lot about last week?
Yeah.
This one? Yeah.
So this really came away as we were speaking, and then after we were speaking, and so the trailing stop I'm using, it's still a fair bit off. It's at around $1.20. So that's the wide trailing stop I use, and it's a calculation. It's a calculation based on the average trading ranges of this stock. So the wider the trading ranges, the wider the trailing stop. It's also back down around the 100-day moving average, which is also a good. I think the 100-day moving average is a good gauge for a medium-term trend following approach. Now I don't know. This maybe that's the high, and maybe it's this time next week it's going to be back at the stop loss. It could go that way. What also could happen is so much just in the 2 weeks prior to the peak. Just look at the acceleration of the trend. It really goes parabolic. So this is where you get the FOMO buying. It starts appearing in the on the nightly news that Drone Shield's up 15% of the day, and people who hadn't heard about it start looking at it, and they think, oh, I've got to get on, and it's all around this new technology, whatever it may be. And FOMO happens, and that causes that real acceleration of the trend. Trend starts to reverse. All those latecomers, they tend to get shaken out. So this is the shakeout of a lot of latecomers, and also people maybe even not so late who got in, who just get spooked by the sell-off. I want to show you another market. So you think, like, looking at this, it looks like, well, this must be all over. This is just going to continue to fall away. I'll show you how this can sometimes play out. So this doesn't mean Drone Shield is going to play out like this, but I look at it, I remember this because the price action to date was so similar. So this is in a commodity, the coca price. Now let me just look at which one I use. There's a couple of different versions of it. I just want to get one with lots of liquidity. This would be the one. Yeah. So remembering, let's get Drone Shield over here. Okay, so there's our drone shield chart. You know, mega rally and then a really sharp decline. Now look at this. Look at Coca. Like if I just pulled this up and said this is a drone shield share price, a lot of people would probably go, yeah, that's how I remember it. Really big run up and then really gave way quickly. Looks quite similar. Also, it's come back to the moving averages, come back to the 100-day moving average. Drone Shield so far has come back to the 50-day moving average. Drone Shield initial decline to the 50, strong rebound off it, and then a secondary decline, which breaks the previous low. Same things happened here. We've got the initial decline, sharp rebound, and then a secondary decline, which breaks the previous low. So it's price action that we do see in these types of situations. Winding this forward to see how this has played out. So what can happen is that you get the parabolic rise and the FOMO comes in. You get the shakeout of the latecomers. This is what we look for with Drone Shield. Now, a Drone Shield may not play out like this, but if it stabilizes around current levels and starts to find support, so is there substance behind this company which is going to make it a stock which does get accumulated on this fall, or is it just froth that the whole story was just like it just fit the current environment and people jumped on it, but there's not the revenues to support the growth in the share price. I don't know which one it is. So this is why we look to the price action. So can Drone Shield, do we see accumulation coming in over the next several weeks to months, which creates a new platform at a higher level, and from there the potential is always for higher levels. We don't know. Let's just watch and see. But you can see how the potential can be if support comes in and it gets accumulated. Or as I say, it just got way ahead of its fundamentals and it's going to come back, trigger the stop, and just be in the doldrums for months or even years ahead. Don't know. A stock like this was we've looked at this before, an environmentally orientated stock, really fitted the green theme of its time. Really big rally, pull back to those averages, got those rebounds, but it didn't find support. It didn't get that new base at higher levels, and over the last 3 years, it's just continued to erode. That's a 500% rally given back over several years. So Drone Shield, I don't know which way it goes. I've still got that wide trailing stop. I'll give it a bit longer. If the trailing stop triggers, it's still been a few 100% gain. But that's what you give back at the end. It's just how some of these big trends work.
Okay. All right. Well, I mentioned it at the start of the show, and because it was the topic of the still is of the week, let's have a look at what CrowdStrike looks like. What's that price action like? It's just that's the one right there. CrowdStrike Holdings.
Yeah. Look at that. There's a tumble. But look, if we looked at it before that, if we would have asked me last week, I would have said, look, upward trend, above the moving averages, rising moving averages, getting a consolidation back to the averages. So you can see, just because something's got a positive structure, it doesn't mean it's magically going to keep rising. That's why we're always looking at, okay, where's our exit point? Because things can change, and they do change. And they changed quite quickly here. So what became a routine pullback just towards that 50-day moving average, it's quickly given way to something else. And we know the cause of it. So a stock like this, let's just put on a wide trailing stop, see what would have happened. So initial entry point would have been as it was getting above the moving averages back in when's that? June last year. Now I need to adjust this, make it wider, get off that default of 3. So yeah, there we have how this would have played out. So from an entry point of say around just after the moving averages cross, around 150%, got up to 160, and the exit triggers at 79. So yeah, it'd be using a 10 ATR stop. It would be it's now at an exit point. But yeah, it just shows trends end. They always trend unless the stock gets taken over. Trends always end and always have corrections, and protect capital when the time comes, because you don't know, is this just going to be the knee-jerk sell-off and it's going to quickly come back? We don't know, or something has fundamentally changed and it continues down. So protecting capital is number one. Got to protect that capital, and yeah, you lose your capital, you're out of the game.
Yep, perfect. Well, it's been good. It's been a good session today once again, and talking a lot about examples of around our stop losses. And as you can see with CrowdStrike, if you're in that and you use that 10 ATR stop, you'd still walk away with a pretty decent percentage up if you were to use that specific stop loss. We'll finish off with a bit of viewer education here on wash trades. I think we might as well just say wash trade involves the selling and repurchasing of a similar asset within a short time frame, often with the intention of claiming a tax loss deduction. So thanks, Neil, thanks for giving us that. Look, at the end of the day, you're better off speaking to your tax accountant around any of those things, because we can't provide any of that advice unless you're an accountant, Jason. I don't know, I'm not sure, or a tax professional.
No,
okay.
Training's my background.
Yeah, I just want to check because I know you're a very smart guy. So, all right, everyone. Thanks, everyone, for attending once again today. Much appreciated, Jason. Thank you for your expertise once again. It's been great.
Yeah, that's been good. Lots of good stuff to go through. So hopefully that's been interesting for everyone. Covered a few different topics, and we go over some. There's always those recurring themes when you look at the charts and thinking about the structures, what we look for, and so hopefully that's interesting to go through all that stuff.
No, I think it is. Look, repetition is the mother of all success, I think, and it can be boring sometimes, but if you want to succeed, this is the way to go, I think. So, for sure. Look, if you like what we do, obviously like and subscribe and comment on our channel. Be sure to, obviously, you can always send in some queries to us at our respective businesses. Obviously, me at Self Wealth and Jason at Motion Trader. The websites are pretty easy to find. Obviously, Jason's at motiontrader.com.au and I'm at selfwealth.com.au. Guys, thank you very much, and I look forward to seeing everyone again next week, next Tuesday. See you later, Jace.
Okay, everyone. See you all next week. Thanks, Rog.
Bye-bye.